You wake up, check your bank account, and see your salary has landed. And within seconds, it vanishes. Rent, the car payment, credit card minimums, and forgotten subscriptions. You are living in a constant state of paying, the normal, expected baseline for the modern consumer. You are constantly told to be financially responsible, save perfectly, cut expenses, avoid borrowing. But if every single person actually did that, the global economy would grind to a dead halt. Without borrowing to pull tomorrow's income into today, people wait years to afford houses, cars, or a college education. Spending drops, corporate revenues fall, jobs disappear. This cycle of personal debt is the intended design, the necessary fuel that keeps the entire economic engine running. Zoom out from your personal credit card, and the scale of this reliance becomes staggering. Right now, governments, corporations, and individuals hold over $300 trillion in combined global debt. To maintain the hyperspeed growth the world depends on, these entities have to continually borrow new money simply to pay off the borrowing they did years ago. If the entire mathematical system relies on perpetual borrowing to pay for past borrowing, how does it avoid a catastrophic explosion? The biggest participants in this massive global borrowing cycle are sovereign governments. They fund domestic crises, they fund international wars, and major public infrastructure by issuing bonds, massive national IOUs sold to investors. Across developed countries today, the average ratio of public debt to GDP has ballooned back to levels we haven't seen since 1945. The weight is severe. The U.S. government spent $880 billion last year on debt interest, approaching 25% of federal revenues. They must issue new debt specifically to cover past interest. It's a hole you cannot dig out of. When a borrower commits a quarter of their income to interest, they lose their leverage. Ultimate power shifts away from elected politicians and directly into their lenders. Those lenders are known in financial circles as bond vigilantes, a massive interconnected network of global investors who act as the ultimate judges of a country's fiscal responsibility. If these investors lose faith in a government's economic plan, they stop buying bonds. The immediate result is that borrowing costs, or yields, shoot up to punishing levels. We saw exactly what this mutiny looks like in 2022, when the UK bond market decided Prime Minister Liz Truss's economic plans were reckless. Pushing those investors too far resulted in an instant crash. The global selling got out of hand rapidly, and within days, borrowing costs and mortgage rates for everyday citizens absolutely skyrocketed. Despite the appearance of complete political control, the bond market serves as the true, ruthless boundary of the global economy. It can crush a nation's finances overnight. This leaves governments backed into a corner. They can't choose severe austerity to pay down debt, because cutting spending that drastically is politically toxic and would instantly crash economic growth. But if they simply continue borrowing without limits, they risk provoking the bond vigilantes into triggering a global financial heart attack. Caught directly in the middle are the central banks. They are frequently forced to step in and override those intense market pressures to prevent a total death spiral. Because severe austerity is impossible and outright default is unthinkable, the system requires a quiet, alternative path to survive. That alternative is a stealth default, facilitated by allowing inflation to run. It neutralizes the bond vigilante's power without causing a sudden market panic. As inflation pushes prices up, the value of that $300 trillion in global debt stays fixed. The burden quietly shrinks. People hate inflation, but easing debt pressure through rising prices is the only way to keep the cycle moving. Your rising grocery bill is the direct result of this systemic survival tactic. Debt serves as the invisible architecture of the modern world, making inflation the mandatory exhaust required to keep the engine from tearing itself apart.